This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice. Welcome to the Luxembourg Fundcast.
Okay, let's unpack this. Welcome to the deep dive. Today, we're really taking on quite a stack of material, plunging us deep into the legal and operational engine room of Luxembourg's fund industry. The Limited Partnership Agreement, or LPA.
That's right.
Specifically, we're tracking the journey of a restated LPA. We'll be exploring, why this fundamental document gets a full overhaul, what exactly changes, how this whole intricate process unfolds, both legally and practically, and what the real-world implications are, especially in light of some pretty significant recent regulatory updates.
Yeah, those updates are key. Our mission today is really to extract the most vital nuggets of knowledge and insight from this material. We want to give you a shortcut, basically, to being truly well-informed on this pivotal aspect of a fund's life. We have here what looks like a really comprehensive analysis. It acts almost like a case study, focusing on the vehicle that's become almost synonymous with alternative investment funds here in Luxembourg, the Special Limited Partnership, the SCSP. That stands for Société en Commandite Spéciale.
The flagship vehicle, really.
Exactly. And this covers everything from the legal underpinnings and the commercial triggers to the drafting nuances, negotiation points, regulatory filings, even the tax angles. It's quite thorough.
It really is. And, it might sound like we're just talking about amending a document, which, on the surface seems pretty administrative.
Right. Paperwork.
Kind of. But what's fascinating here, I think, is how a restated LPA, particularly that first one, represents such a fundamental transformation for a fund. It's the legal manifestation, if you like, of moving from that conceptual fundraising phase to concrete operation. Ah, okay.
It locks in the terms that will govern the fund, its investments, its relationships with investors for maybe a decade, maybe even 15 years. So understanding this process isn't just about, ticking a legal box.
No, definitely not.
It's understanding the moment a fund truly comes alive. It solidifies the deals, the detailed governance structure, the precise operational rules that are going to dictate its success for years. It really is where the rubber meets the road for the fund's strategy and its investor relationships.
That's a great way to frame it. It's not just paperwork. It's the fund's actual rule book coming into full effect. So let's start right there, at the foundation. This document, the LPA, it's described in our sources as the constitutional bedrock for alternative funds in Luxembourg. What makes it so central?
Well, think of it as the fund's DNA, its internal constitution, if you will. For alternative investment funds, especially the SCSP, the Limited Partnership Agreement is the absolutely foundational document. It's not just a document related to the fund. It is the partnership agreement itself, the contrat social, as it's often referred to in the legal texts. Social contract. Okay.
Exactly. And this single document defines everything critical. How the fund is governed at the highest level, how its operations will run day to day, and maybe most crucially, precisely how the economics of the fund, how profits, losses, expenses are shared, how that gets allocated between the partners.
And the SCSP, the Société en Commandite Spéciale.
Yeah.
Why is that the main focus here? It seems to pop up everywhere in alt investments in Lux.
It truly has become ubiquitous. The SCSP is now, I'd say, the dominant choice for alternative investment funds domiciled in Luxembourg. You see it widely used for strategies like private equity, real estate, private debt, infrastructure, venture capital. The list goes on.
Right.
Our sources confirm this widespread popularity. Its legal basis is rooted in Luxembourg's core company law, specifically the Consolidated Law of 10 August 1915 on commercial companies, commonly known as the 1915 Law.
The 1915 Law, okay.
And this law sets out the basic structure. You must have one or more general partners, GPs, who bear unlimited liability for the partnership's debts and commitments, and then you have one or more limited partners, LPs, whose liability is strictly capped or limited to the amount of capital they've committed to the fund.
Okay, so GPs, unlimited liability, LPs, limited to their contribution.
Okay.
That's the basic risk distinction. But the sources mention a key nuance about the SCSP. It lacks a distinct legal personality separate from its partners. That sounds a bit counterintuitive when you say it can hold assets or sue people. How does that work?
Yeah, that's one of the clever aspects of the SCSP design under the 1915 law, and it's really crucial to understanding its flexibility. While it doesn't possess a separate legal personality like, say, a limited company, an SA or an SARL does,
Right.
meaning legally, it's often seen just as an aggregation of its partners. The 1915 law explicitly grants its specific functional attributes. It can, in its own name, be registered with the Trading Companies Register. It can hold assets like property or shares. It can enter into contracts. And importantly, it can engage in legal actions. It can sue or be sued. So despite the technicality, it basically functions like an independent entity.
Pretty much. From an operational perspective, yes. And the core concept that underpins this dominance and allows this flexibility is the principle of liberté contractual freedom.
Contractual freedom.
This is the paramount reason for its popularity. The section of the 1915 law governing the SCSP is deliberately minimal. It imposes very few mandatory rules. Almost everything, the detailed management structure, decision-making processes, the complex mechanics of distributions, transfers of partnership interests, even redemptions, if applicable, is largely left to the partners themselves to define and agree upon within the LPA. The law itself calls the LPA the contrat social. That sounds incredibly powerful. So instead of being stuck with rigid rules set by law, the GP and LPs can basically write their own custom rulebook.
Exactly. And that's precisely why the LPA matters so much and why restating it is such a big deal. This contractual freedom allows the parties, primarily the fund sponsor, the GP, and the various institutional investors, the LPs, to tailor the fund structure, its operational rules, its economic sharing with surgical precision.
Tailored to the specific strategy.
Perfectly, to match their specific investment strategy, their negotiated commercial deal, and the unique needs of their particular investor base. This level of customization is incredibly valuable for alternative strategies that often have bespoke models, fee structures, distribution goals, things that just wouldn't fit neatly into a rigid statutory box.
Makes complete sense. It's not off the shelf, it's custom designed. So given how central this document is, why does it get a full overhaul? Why go through the whole process of not just amending, but completely restating the entire agreement?
Well, our sources point to two primary catalysts for a full LPA restatement. The first, and by far the most common trigger, is the fund's initial first closing.
So right at the start of the fund's active life.
Precisely. The typical way you set up a new fund vehicle in Luxembourg, especially an SCSP, involves starting with a very simplified, often called a short form or initial LPA.
A short form LPA.
Yeah, it's a pretty bare bones agreement. It's signed initially just by the GP and a nominal, often affiliated, initial limited partner.
Okay, and what's the thinking behind using the short form first? Why not just jump straight to the full complex one?
It's mainly about speed and confidentiality during fundraising. Using a short form lets the GP set up the legal entity really quickly and cheaply.
Oh.
It gives them a legal shell to hold the name and basic details while they're still out marketing the fund. And crucially, it maintains confidentiality because the identities of the main institutional LPs who eventually join at the first closing, well, they don't need to be disclosed publicly when this initial short form is filed with the Trading Companies Register.
So only the GP and this nominal initial LP are public at first.
Typically, yes. So the short form is really just a placeholder, a quick way to get the entity registered while keeping the main investors private for a while.
Got it. A placeholder.
Exactly. It serves its purpose for formation. Then, at that critical first closing, when the definitive investors formally commit their capital and are legally admitted as partners, that initial short form LPA is entirely superseded. It gets replaced completely by a comprehensive, detailed, amended, and restated LPA, the A&R LPA.
The A&R LPA.
And this is the document that finally incorporates all the complex, heavily negotiated commercial terms that have been thrashed out between the GP and the incoming LPs over months of fundraising and negotiation.
And the sources even mentioned the specific legal wording used for this switch.
They do, yeah. They point to the language you typically find in the preamble, the whereas clauses, at the start of the A&R LPA. It usually says something like, the parties initially formed the partnership under the initial agreement, but now, with new partners coming in, they desire to continue the partnership and formally amend and restate the initial agreement by its substitution in its entirety.
Okay, substitution in its entirety.
That specific wording is legally important. It formally affects the complete replacement of the short form with the A&R LPA, and it often handles the mechanics of the initial nominal LP withdrawing and the new investors being legally admitted.
So that's the first very common trigger, the moment real investor money comes in. What's the second main reason for a full restatement mentioned in the material?
The second category involves a more fundamental strategic or regulatory change after the fund is already up and running with investors. This could be a major shift in the fund's core investment strategy.
Like adopting ESG formally.
Exactly. For instance, if a fund decides to formally and legally adopt a binding environmental, social, and governance ESG mandate that goes beyond just, policy statements, if it's meant to be a legally enforceable obligation impacting investment decisions, manager duties, it needs to be hardwired into the LPA itself.
Right, into the legal obligation.
Into clauses about investment objectives, restrictions, GP duties, reporting requirements. A full restatement is often just the cleanest way to integrate such a significant change across the whole document.
So really embedding it legally.
Yeah.
Makes sense. What else falls into the second category?
Another trigger could be a change in the fund's regulatory status. For example, an unregulated SCSP, which has maximum flexibility, might later decide to opt in to the Reserved Alternative Investment Fund. That's the RAIF regime.
The RAF regime. Okay. Why would they do that?
The big benefit is gaining an EU marketing passport under the Alternative Investment Fund Managers Directive, the AIFMD. That makes marketing to institutional investors across the EU much simpler.
Ah, the passport. Big advantage.
Huge advantage. But it's a fundamental regulatory shift. It means the fund is now governed by the specific RAIF law of 2016 and must be managed by an authorized alternative investment fund manager, or AIFM. That brings a layer of regulatory oversight. This regulatory transformation requires corresponding changes in the LPA, often best handled through a restatement.
And finally, the sources just mentioned housekeeping.
Yeah, that's a practical point. Over several years, a fund might have made numerous smaller amendments to the LPA, maybe through separate little addenda or amendment agreements.
Patchwork LPA.
Exactly. While legally fine, it can become a bit fragmented and confusing. A restatement lets everyone consolidate all those previous changes into one single, clean, authoritative document. It just makes life easier administratively.
Okay, so we've got the big first closing transition, major strategic or regulatory shifts, or just cleaning things up. Let's circle back to that first closing trigger, the most common one. We talked about the short form being replaced by the A&R LPA, but here's where our sources flag something really interesting, a critical, almost archaic legal formality in Luxembourg and how the modern fund market found a clever workaround.
Right. This is a classic case of legacy law meeting modern global finance practice. Luxembourg company law, rooted in civil law traditions, has this specific formality for partnership agreements. For the agreement to be legally valid, it must be executed in 2 original copies.
2 physical wet ink originals of potentially a huge document.
Exactly. And the sources point out the theoretical risk. Failure to strictly follow this 2 originals rule could potentially render the partnership agreement, and maybe even the partnership itself, null and void. Legally, any interested party could potentially invoke this.
Wow. That seems like an almost impossible hurdle for a global fundraise. Imagine trying to get dozens, maybe hundreds, of investors worldwide to each sign 2 physical originals of a 150-page document, then collecting them all.
It is a massive practical challenge, the logistics alone. Coordinating the signing and collection of potentially hundreds of wet ink signature pages globally, it's hard to overstate how difficult that would be.
And confidentiality too, right?
Absolutely. Back to our earlier point, requiring every LP to sign the same 2 originals would completely blow the confidentiality of the LP list. Everyone would see who else is in the fund, which LPs generally want kept private.
So how on earth do they handle this in practice for a big fundraise? What's the elegant solution?
This is where standard market practice kicks in. Investors, as part of their subscription documents when they commit capital, grant a power of attorney, a POA, to the general partner.
A power of attorney, okay.
It's a specific written authorization. It empowers the GP to execute the A&R LPA on their behalf as their legal representative.
So instead of each LP signing the 2 originals, the GP signs the 2 required originals for everyone using these POAs.
Precisely. The GP collects the POAs from all the incoming LPs. Then the GP, or the representative, executes the 2 required original copies of the A&R LPA. This legally binds all the LPs based on the authority granted in their POAs.
That's clever.
It elegantly solves the logistical nightmare, maintains LP confidentiality because the signature pages on the 2 originals only show the GP signing on behalf of each LP, and crucially, it satisfies that legacy legal requirement for 2 originals.
That really is an elegant piece of legal and operational engineering. It bridges the gap between an older rule and modern global finance, keeps things confidential, and streamlines what could be a total mess. So once you've navigated the why and the how of getting to the A&R LPA, the next phase is actually drafting it. The sources call this legal engineering, turning commercial terms into solid legal code.
It absolutely is legal engineering. It's this complex, critical process of taking the commercial understanding, the terms agreed in principle, often from a term sheet, due diligence, side letter talks, and translating them into precise, legally robust, resilient language in the LPA.
It's more than just writing down the deal.
Oh, much more. The goal is anticipating a huge range of potential future scenarios, conflicts, operational challenges that might pop up over the fund's life, 10, 12, 15 years maybe, and creating a legal framework that holds up and gives clear guidance in those situations. You're essentially building the fund's entire legal operating code for its lifetime.
Let's dive into some of the most critical clauses that make up this code. The sources spend a good bit of time on the economic engine, clauses the financial heart.
Yeah, these are absolutely fundamental. They define the GP-LP relationship financially and are always intensely negotiated during fundraising. The first, and maybe the most complex, is the distribution waterfall.
Sounds like it dictates how the money flows back out.
Exactly. The waterfall is a multi-layered structure defined in painstaking detail. It dictates the strict priority in which cash received by the fund from exits, dividends, interest, etc. is distributed to the LPs and the GP. In Europe, our sources confirm the dominant model is the fund as a whole, or European-style waterfall.
Fund as a whole. Okay, European style.
Under this structure, the GP only gets its performance fee, the carried interest, after 100% of the capital contributed by all LPs has been returned, plus a specified preferred return, often called the hurdle rate.
So LPs get all their money back plus a minimum return before the GP sees any profit share. It's like any carry.
Exactly. Only once that threshold is met are distributions then typically split, with a big chunk going to LPs and the smaller percentage, usually 20%, going to the GP as carried interest until the GP catches up to its full entitlement based on total profits.
And European LPs prefer this.
Strongly prefer it. It provides significantly greater investor protection. It ties the GP's ultimate pay directly to the overall success of the fund across all investments. It avoids the situation where a GP takes profits on early winners even if other deals are tanking, which can happen with the deal-by-deal or American-style waterfall.
Okay, so the European waterfall really aligns GP incentives with the LP's overall outcome. What about management fees?
Another crucial economic piece. The LPA specifies how the GP gets paid for, managing the fund day to day, making investment decisions. It's typically an annual fee, often a percentage of committed capital during the investment period. Sources suggest common ranges like 1.5% to 2% per year.
And then it changes later.
Often, yes. After the initial investment period ends, it usually steps down to a percentage of the net invested capital or the cost of the remaining investments.
And there's a specific, often heavily negotiated provision linked to these fees, the fee offset.
Yes, absolutely vital for aligning interests, the fee offset provision. This clause requires that certain fees the GP or its affiliates get from the portfolio companies the fund invests in, things like transaction fees, directors' fees, monitoring fees, must be used to reduce the management fee the LPs would otherwise pay the GP.
Reduce it by how much?
The percentage offset is usually high. Often 80% to 100% is negotiated.
So this stops the GP getting paid twice, effectively. Once from the LPs via management fee and again from the portfolio company.
Precisely. It prevents double dipping. It's a direct way to ensure the overall fee load on LPs is fair and that LPs benefit when the GP generates fees at the portfolio level.
Makes sense. And what about the carried interest itself, the GP's profit share and that hurdle rate you mentioned?
Right. Carried interest, or carry, is the GP's slice of the fund's overall profits, but only after LPs get their preferred return in capital back. It's often benchmarked against the classic 2 and 20 model 2% management fee, 20% carry.
But that varies.
Oh, yeah. It varies significantly. Sources note this is just a benchmark. Debt funds might have lower fees and carry. Top VCs might command higher percentages. It depends on the asset class, strategy, track record. The hurdle rate, or preferred return, is that minimum annual return LPs must get before the GP gets any carry distributions.
And the standard hurdle?
Sources state 8% per annum is a long-standing market standard, though like everything, it can be influenced by interest rates and market conditions during the fundraising.
So in that European waterfall, capital back plus that 8% annual return, then the GP gets its carry.
Correct. And to protect LPs further, especially regarding carry paid out early in the fund's life, there are two critical mechanisms mentioned, clawback and escrow.
Clawback and escrow. How do they protect LPs?
Clawback is a legal obligation on the GP in the LPA. Because carry might be distributed during the fund's life based on early successful exits, it's possible that by the very end, when the final tally across all investments is done, the LPs haven't actually received their full capital back plus their preferred return.
I see.
The clawback provision requires the GP to return any over-distributed carry back to the fund so the LPs get what they're contractually owed according to the waterfall.
So the GP literally has to give back profits received if the overall fund doesn't justify them.
Exactly. It secures the GP's promise on the whole fund performance for LPs. And to give LPs security that the GP can actually meet this potential clawback obligation years down the line, LPs often negotiate an escrow mechanism.
Escrow, like holding money aside.
Yes. It means a specified portion of the GP's carry distributions, say 30 or 40%, isn't paid directly to the GP. It's held in a separate, ring-fenced escrow account until the fund winds up and its final performance and clawback liability, if any, can be definitively calculated. This account acts as security for that potential clawback.
Creates a bit of tension, I imagine.
Naturally. Sources note this tension. GPs want access to their carry earlier to reward their team. LPs want the security of the escrow. It's a balancing act.
Okay, those economic terms are clearly the financial backbone. Let's shift gears to governance and control. The LPA also defines that critical balance of power between the GP and LPs.
Absolutely. The governance clauses decide who has authority over what and what protections LPs have. Key clauses here include GP removal. The LPA meticulously specifies when the GP can be removed for cause. Serious stuff like fraud, gross negligence, willful misconduct, material breach of the agreement.
Standard stuff. But there's more.
Yes, a crucial negotiation point, especially for big institutional investors, is the inclusion of a no-fault removal right.
A no-fault removal. What does that allow?
It allows a supermajority of LPs, typically needing consent from partners holding 75%, maybe even 80% or more, of total committed capital to remove the GP without needing to prove specific misconduct in court.
Wow. So if LPs just lose confidence?
Exactly. Or if performance is consistently poor, but doesn't hit that high for cause bar, it's a mechanism for LPs to change the manager. The terms of such a removal, like any compensation for the outgoing GP, are, as you can imagine, intensely negotiated. Very high stakes.
Significant LP leverage there. Another related clause mentioned is key person events.
Yes, vital. Because LPs invest largely based on the specific expertise and track record of the senior execs at the GP firm, the key persons. This clause protects LPs if one or more of these designated individuals stops dedicating the required time. Maybe they leave the firm, become incapacitated, significantly reduce their involvement.
What happens if a key person event is triggered?
Typically, sources say it triggers an automatic suspension of the fund's investment period. That's a big deal. It means the GP is legally blocked from making any new investments until it's sorted out.
And the LPs get control.
Usually, yes. The LPA then gives LPs control. A majority, often simple majority by capital, gets a period to vote on whether to reinstate the investment period or maybe take other actions like looking for a replacement DP or winding the fund down. It gives LPs crucial control if the core team they backed changes fundamentally.
Makes total sense. You invested in that team.
Yeah.
And there's also a formal body for LP representation, the LPAC.
The Limited Partner Advisory Committee, or LPAC, usually composed of representatives from some of the fund's largest or most influential LPs. It's important to be clear on its role, though. The LPAC does not have management power. The GP manages day-to-day.
So what does it do?
It serves a critical governance function. The LPA gives the LPAC specific authority, like reviewing and approving potential conflicts of interest between the GP and the fund, consenting to changes in valuation methodology, providing input on other significant matters needing LP oversight, but not direct management.
Okay, shifting now to the practical day-to-day running. What are the critical clauses for operational integrity in the A&R LPA?
These ensure the fund operates smoothly, predictably. The process for capital calls and drawdowns is meticulously defined. This section details how the GP calls or requests bits of the LP's committed capital.
Like notice periods.
Exactly. It covers things like the required notice period for a drawdown notice, typically 10 business days, and explicitly states the permitted uses for the called funds, usually investments, operating expenses, and management fees.
And what if an LP fails to pay up? That sounds disastrous.
It could be, which is why the defaulting partner provisions are vital and intentionally punitive. These clauses outline very strong remedies the GP can use against an LP who fails to fund a capital call on time.
Like what?
Common remedies include charging very high default interest, potentially stripping the defaulting LP of their right to participate in future investments, and in serious cases, forcing the sale of their interest at a big discount, or even complete forfeiture of their interest and prior contributions.
Ouch. Severe, but necessary, I suppose.
They're designed as deterrents, really. These provisions are critical for the fund's financial health and are often a key focus for lenders providing subscription line financing those loans backed by LP commitments. The lenders rely on these default remedies being strong.
Right. And finally, reinvestment and recycling.
Yes. LPAs often include provisions for this. Recycling allows the GP, usually during the investment period, to take proceeds from an early successful exit, say, selling a portfolio company, and instead of immediately distributing that cash back, to recycle or reinvest it into new opportunities within the fund's strategy.
Keeps more capital working.
Exactly. Helps maximize the total capital deployed. Sources mention the amount that can be recycled is usually capped, maybe as a percentage of total commitments or capital called.
So the A&R LPA is this incredibly comprehensive legal code, financials, governance, operations. Negotiating all these details must be incredibly complex.
It is, and the drafting process we talked about, that's really the outcome of this intense negotiation arena. You've got the GP and their lawyers, and on the investor side, it's heavily influenced by sophisticated institutional investors, big pension funds, sovereign wealth funds, endowments, funds of funds.
The big players have leverage.
They often do because of the size of their potential checks. Smaller investors might have less sway over the standard terms in the initial draft LPA.
What are the typical battlegrounds in these negotiations? Where do GP and LPs usually dig in their heels?
Well, as you might guess, the most frequent and intense fights are over the economic terms. Management fee levels, the scope of fee offsets, the nitty-gritty of the distribution waterfall, carry percentages, hurdle rates.
All money stuff?
Pretty much. Governance rights are also heavily debated. The threshold for LPs to remove the GP, the definition of key person events, the LPAC's powers. Transparency is another big one, how much reporting, how often. It's always a balance between the GP wanting flexibility and fair pay, and LPs needing control, protection, and visibility.
And here's where our sources highlight something really interesting in the negotiation phase. Side letters. What are they, and why are they such a big deal here?
Side letters. They're separate, confidential agreements negotiated and signed just between the GP and one specific LP. They exist alongside the main LPA, but amend or supplement its terms only for that particular investor.
So one investor basically gets different or better terms than everyone else who signed the main LPA.
Exactly. It's a common feature, especially for larger or strategically important investors, maybe an anchor investor who helps get the fund off the ground.
What kind of better terms?
Common examples are reduced management fees, enhanced information rights, more detailed reporting, a guaranteed LPAC seat, maybe preferential rights to co-invest alongside the fund.
This sounds like it could create a fund where different investors have quite different deals with the GP.
It absolutely can. And the fact that these side letters proliferate makes one particular clause in the main LPA incredibly critical and often complex to negotiate. The most favored nation, or MFN provision.
MFN. Most favored nation. What does it do?
A broad MFN clause gives an LP the right to see the terms granted to any other LP in a side letter, and then, crucially, to elect to get the benefit of any terms in those other side letters that are more favorable than their own.
So it's basically a fairness clause. Stops LPs getting a much worse deal than others.
Precisely. It's a way for LPs to ensure some level of equality or at least transparency about different terms. GPs, understandably, try to limit the MFN scope. They might negotiate tiers, like only LPs committing over X amount get MFN rights for side letters given to other LPs in that tier, or they might carve out certain things from the MFN altogether, like LPAC seats or co-invest rights, arguing those are unique deals. The negotiation around the MFN's scope is really a negotiation about fairness and transparency among partners. It's a big part of the fundraising dance.
Fascinating. So once all this intense drafting and negotiation wraps up, A&R LPA agreed, side letters sorted. What's the procedural gauntlet it has to run in Luxembourg?
Right. After the A&R LPA is finalized and agreed, it has to be formally adopted and meet specific filing rules under Luxembourg law. Now, the LPA itself usually says how amendments get approved internally, maybe a GP decision, maybe a majority LP vote. But the 1915 law provides a crucial legal backstop for the really fundamental changes.
What does the law step in for?
According to Article 326 of the Consolidated 1915 law, any amendment changing the partnership's core purpose, its corporate object, altering its nationality, transforming it into a different type of company, or deciding its liquidation must be decided by the partners.
So LPs have the final say on those big things.
Yes, and the sources highlight that if the LPA doesn't specify a higher voting threshold for these specific existential decisions, the law's default rule applies. Voting rights are proportional to each partner's interest.
So even with all that contractual freedom, LPs keep ultimate statutory control over the fund's core identity and existence.
Exactly. That's a core protection you can't contract away. Beyond partner consent, the other key procedure is filing with the Luxembourg trade, and companies register the RCS, Registre de Commerce et de Société. An extract of the amending deed documenting the A&R LPA's adoption has to be filed.
And this filing makes fund info public.
Yes, the RCS filing makes certain key info publicly accessible for legal certainty, but, and this is where the SCSP structure is clever, what's not required to be filed publicly is the full A&R LPA document itself.
Ah, so the sensitive stuff stays private.
Exactly. All the highly sensitive commercial terms, specific LP identities and commitment amounts, the detailed waterfall, specific fees and carry percentages, clawback details, GP removal thresholds, key person definitions, all that remains private and confidential to the partners and the fund admin.
So the public filing is just a summary, an extract?
Precisely. The sources clearly distinguish this. The RCS extract only needs to disclose basic, non-sensitive info. GP identity, manager identity, if different, fund name, duration, object, registered office. This split public filing of basic ID info, confidentiality for core commercial terms, is a cornerstone of the SCSP's appeal. It balances transparency with safeguarding sensitive commercial details.
That balance makes a lot of sense. Now let's talk practical realities. Our sources flag some significant recent changes in the market context, especially around filing procedures and costs that have major practical implications.
Yes, this is where the operational landscape has genuinely shifted lately, adding new complexities and risks. Let's hit costs first. The direct admin filing fees with the RCS are still pretty modest. Sources say a standard modification filing is around €10.96, plus maybe €12 for a private deed, so roughly €23.28 total admin costs.
Negligible compared to the legal fees for drafting a negotiation.
Exactly. The vast bulk of the cost is professional fees. But you mentioned punitive fees for late filing. This is where the big recent change comes in.
Yes, this sounds important. What happened? What are the new penalties?
This is a major procedural update effective March 2025. It introduces a punitive escalating fee structure for missing the mandatory one-month deadline for filing documents, including the A&R LPA extract with the RCS. Historically, missing this might have been a minor issue, but now it carries real financial penalty risk.
How much?
According to the analysis, a filing just 1 month late, so filed during month 2 after execution, incurs a €50 penalty. If it's filed between months 3 and 4, it jumps to €200. And from month 5 onwards, a hefty €500 penalty.
€500 for what used to be maybe a slap on the wrist? That's a serious incentive change.
It is. It turns that 1-month deadline from a guideline into a strict, financially significant compliance requirement. A simple admin delay now directly risks costing the fund real money.
And this punitive fee links directly to the practical timeline for the whole process. The sources break that down.
Yes. Understanding the timeline is crucial for managing this risk. It's typically 4 phases. Phase 1, pre-drafting data gathering, maybe 2 to 4 weeks, finalize the term sheet. But, and this is the new critical dependency, proactively collect Luxembourg National Identification Number, or LNIN, data and supporting ID docs from all natural persons involved who will need RCS registration.
Why has collecting this LNIN data up front become so critical now, right at the start?
Because of new rules tied to the filings, which we'll get into. But the key timeline point is you cannot complete the filing without this data later. So, phase 2. Drafting negotiation, usually the longest, 4 to 8 weeks, maybe more. Draft the LPA, circulate, negotiate terms, side letters. Risks here are delays reaching agreement, scope creep. Phase 3, execution closing 1 to 2 weeks. Finalize subscription docs, including those crucial POAs. GP executes the 2 LPA originals using the POAs. Risks are logistical delays getting POAs back, ensuring correct execution.
And then phase 4, post-closing filing. The crunch time.
Exactly. This phase must be done within that strict 1-month window after execution. Prepare the extract, file it electronically with RCS, update internal registers, the major risk now. Explicitly missing that tight 1-month deadline and triggering those escalating penalties.
So that new requirement to collect LNIN data right in phase 1 is directly linked to avoiding potentially hundreds of euros in penalties if the phase 4 filing gets delayed.
Absolutely. Sources make this clear. Timely receipt of complete, accurate LNIN data and supporting docs is now a critical path item. It's a mandatory upfront step you have to manage diligently from day one to prevent delays later, specifically in that final filing phase that could trigger those 200 or 500 euro penalties.
This sounds like it fundamentally changes the operational burden and risk profile for fund managers and administrators in Luxembourg.
It really does. The LNIN requirement plus the CSSF's parallel shift to digital submissions aren't just minor tweaks. They represent a significant shift towards a more data-centric, digitized, and crucially front-loaded compliance model.
Front-loaded.
Yes. It basically re-engineers the RCS filing process. What used to be a relatively document-centric admin task done after closing has become a person-centric, preemptive data collection exercise needed much earlier, during initial onboarding or pre-closing.
And the high-stakes link is now explicit. New personal data requirement plus severe late filing penalties equals direct financial consequences for admin delays.
Precisely. Clear, high-stakes link between admin diligence, data accuracy, and the fund's bottom line. You can imagine the pressure. Sources even give an anecdote. A single non-responsive director, a busy GP contact slow with their details, an LP contact person not providing data quickly. One individual delaying their LNIN or docs can now realistically hold up a filing and trigger that 500 euro penalty.
So GPs and admins need a new strategy.
They have to. Treat collecting personal data, LNINs, certified IDs, proof of address not as a later back-office task, but as critical initial onboarding for any individual needing RCS registration. It changes the internal compliance timeline and elevates data management to a key operational risk needing senior attention.
Let's quickly dive deeper into the LNIN requirement itself. What are the specifics?
Okay. Mandatory LNIN requirement effective November 12, 2024. Since then, any RCS filing involving a natural person, director, manager, partner, shareholder must include their LNIN. This applies to all natural persons needing registration, regardless of residency.
And if someone, like a foreign director, doesn't have an LNIN?
They need to request one from the LBR, the Luxembourg Business Registers, which runs the RCS. The request needs specific personal data: full name, date, place of birth, nationality, gender, private residential address.
Supported by documents.
Yes. Certified copies of ID, passport ID card, and proof of address dated within the last 6 months, like a utility bill. Documents not in French, German, Luxembourgish, or English need a simple translation. You can request the LNIN as part of a filing or standalone via the LBR's online portal.
So this data collection, verification, maybe the LNIN request itself, as a significant mandatory upfront step that wasn't there before, or at least wasn't as critical time-wise.
Precisely. It's now a non-negotiable prerequisite on the critical path for timely filing. And relatedly, for regulated funds, the regulator, the CSSF, Commission de Surveillance du Secteur Financier, has also gone digital. Effective April 1st, 2025, the old physical visa stamp on prospectuses is replaced by a new digital e-identification system.
E-identification.
Yeah, it assigns a unique digital ID. Requires all prospectus submissions new or updated via the CSSF's eDesk platform electronically. This matters because, as we'll see next, a material LPA restatement for a regulated fund nearly always means updating its prospectus too.
So the whole procedural landscape, RCS and CSSF, is getting more digitized, data-dependent, and demanding upfront diligence. Finally, let's look at the ripple effect. A restated LPA doesn't exist in a vacuum. It triggers other things.
Yes. The most direct ripple is on other key fund documents, especially for regulated funds like UCITES, SEFs, specialized investment funds, and RAIFs, reserved alternative investment funds. For these, the offering memorandum or prospectus is a legally required document. It must accurately reflect the fund's structure, terms, and operations.
And how does the LPA restatement specifically impact that prospectus?
There's a direct libel link. Any material change to the fund's structure, investment policy, governance, key terms codified in the A&R LPA legally requires a corresponding update to the prospectus.
What counts as a material change?
Sources list examples. Significant change in investment policy restrictions, altering the fee structure, modifying governance like GP removal rights, or changing regulatory status itself like opting into the RAIF regime.
And these prospectus updates need regulator approval.
Yes, for regulated funds, the CSSF has to approve them. The manager submits a request, usually initially via a specific CSSF email, with an explanatory letter detailing the changes from the A&R LPA and a track-changed prospectus showing the amendments.
CSSF reviews it.
Yes, they review my comment. Once approved, the final clean version gets submitted via that new digital e-identification system on eDesk. And importantly, sources note, for material changes, the fund usually must notify investors, often giving them a notice period, commonly 1 month, where they can typically redeem free of charge if they don't like the new terms.
An important investor protection. If the deal changes fundamentally, they get notice and an out. What about tax implications? Sources say restating the LPA itself isn't taxable, but the terms within it are crucial.
Correct. The act of amending restating doesn't trigger tax itself, but the partnership structure and the economic terms defined in the LPA have profound tax implications for the fund and its partners. The foundational tax feature of the SCSP, and a big reason for its popularity, is its inherent tax transparency by default.
Tax transparency. What does that mean in Luxembourg?
It means normally the SCSP itself isn't subject to Luxembourg corporate income tax, CIT, or net wealth tax, NWT. Instead, profits and losses flow through directly to the partners' LPs and GP and are taxed at their level according to their home country's rules.
Avoiding tax at the fund level. Big advantage.
Huge. But there are risks that could potentially mess this up and make the SCSP taxable in Luxembourg.
Are there?
Yes, sources highlight 2 key tax risks the LPA helps manage. First is municipal business tax, or MBT. An SCSP can inadvertently become tainted and subject to Luxembourg MBT.
How does it get tainted?
If it's deemed to be conducting commercial activity itself, or, more commonly, if its GP is a Luxembourg resident capital company, SARL SA, holding 5% or more interest in the partnership.
And how do you avoid that?
Standard structuring, codified in the LPA, is to ensure the GP's interest is purely nominal, typically 1%, sometimes even 0.01%. That nominal interest, plus the GP's role being limited to managing investments, not running a broader commercial business, helps avoid the commercial taint by statute. Keeps the SCSP out of MBT.
Okay, keep the GP's stake tiny. What's the second tax risk?
This one's more recent and complex. Stems from the EU Anti-Tax Avoidance Directive, ATAD, implemented in Luxembourg. Specifically, the reverse hybrid mismatch rules, effective from January 1st, 2022. These can, in specific situations, actually make an otherwise tax-transparent SCSP subject to Luxembourg CIT on some of its profits.
A reverse hybrid mismatch. When would that happen?
It's triggered if one or more non-resident LPs are in a jurisdiction that views the Luxembourg SCSP as opaque, meaning it doesn't see it as flow-through like Luxembourg does. And because of this classification mismatch, the income allocated by the SCSP to that LP is not taxed in their home jurisdiction.
Wow, complex.
Highly technical. But sources mention an important clarification. The rule isn't triggered just because an investor is tax-exempt, like a pension fund, or lives in a no-tax jurisdiction. It's specifically about this classification mismatch causing income to fall untaxed between jurisdictions.
Because it's a complex interaction between Luxembourg law and the LP's home country tax treatment that could make the SCSP accidentally taxable.
Precisely. And while just restating the LPA doesn't trigger these rules, any changes made during that restatement to partnership composition, economic rights must be carefully analyzed by tax counsel to ensure they don't inadvertently create a reverse hybrid mismatch. It's a critical layer of tax complexity the LPA needs to reflect accurately.
Wow. So what starts as a seemingly focused legal document process amending the LPA just cascades into critical considerations across regulatory filings, investor relations, potential admin penalties, the fund's whole tax position. It really is a pivotal moment.
It really underscores how interconnected the legal, operational, and tax aspects are in fund structuring here in Luxembourg.
All right. We've really journeyed through the life of a restated LPA today. We covered the LPA as the fund's core constitution, the key triggers for restatement from that crucial first closing transition to later strategic shifts or just housekeeping. We looked at the intricate process of turning commercial terms into robust legal code, the intense negotiations around key clauses covering the economic engine, waterfall fees, carry, clawback, escrow, governance, GP removal, key person, LPAC, and operations, capital calls, defaults, recycling.
Covered a lot of ground.
We highlighted that vital role of the power of attorney workaround for navigating legacy legal formalities and global fundraising while keeping things confidential. We delved into the negotiation dynamics, including side letters and the critical most favored nation provision. We also examined the procedural gauntlet partner consent, RCS filing, focusing on the big practical impact of those new punitive late filing fees and the mandatory upfront LNIN requirement.
Can't forget those.
And finally, we explored the ripple effect on regulated fund prospectuses, including the CSSF's new e-identification system, and touched on those important tax considerations, SCSP transparency, MBP risk, and the newer complexities of reverse hybrid rules. You should now have a much clearer, much deeper picture of this pivotal moment in a fund's life and all the intricate details professionals navigate.
It's certainly a landscape that keeps evolving, especially with the increasing focus on data and transparency.
Absolutely. So, what does this all mean? Considering this escalating regulatory focus on detailed personal data collection and the very significant financial penalties now tied to administrative missteps and late filings, does this fundamental shift towards a more front-loaded, person-centric compliance model fundamentally change the operating risk profile for fund managers in Luxembourg? And if it does, how might this influence the actual administrative structures and operational processes they need to put in place to succeed going forward? This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice. Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.